You are listening to Mining Stock Education.
I think it's very wise thing to say and to bring up in that context. And I think that is the problem with probably about 80% of the fear out there is probably linked to laziness, as he suggests. And that people, just my interactions and questions as a newsletter writer have pointed to the fact that a lot of people are more interested in just the picks rather than the rationale behind picking the certain company or the detailing the thesis of why you're buying a company.
Because it gets you to think through your weaknesses and what you could succumb to. And in a moment of self-disclosure, and don't beat me up in the comments, I'll just say this, Brian, I was conned yesterday. Thanks for tuning in to the monthly conversation between myself, Bill Powers, and Brian Leni, co-hosts of Mining Stock Education. Brian also writes a newsletter at juniorstockreview.com. And in today's show, we're going to talk through some of the happenings of the past month, questions we've gotten from listeners. And Brian, I'd like to start off by talking about what you found interesting over the last month of MSE interviews, and you've conducted a number of them. What were some of the things that jumped out to you, either for your own learning or you thought it was insightful overall for the sector?
I think probably the two biggest things, I'll start with Lisa Davis. I interviewed her near the beginning of the month, just after she had come back from the Quebec conference. And she did her presentation on flow-through financings and sort of the changes that have been occurring and what she saw ahead. And that continued into our discussion. And I think the biggest point that she covered that I thought was pertinent to investors in Canadian companies is the fact that flow-through dollars look like they're going to be able to be applied to development costs. So, instead of exploration or like ground or baseline exploration work, you could put them towards PEAs, PFSs, feasibility studies, and therefore that development companies are able to access these funds and put them to use in some of these bigger ticket items. Like the PFS for companies can be $30 or $40 million. If you're able to raise those dollars at a premium, which flow through is at, and apply that to your development costs, I think that's a huge advantage for the Canadian developers, in comparison to some of the other companies. The other one, and as always, Rick Rule is always an inspiration, and a lot of knowledge is gleaned every time I talk to him. I think the conversation on optionality, I've been getting a lot of questions in the newsletter and prompts from people within my network looking at actual optionality companies, and I've really hesitated to kind of delve into the optionality side. And I'll define optionality because I think that's pretty important. If you go back a year and a half or 2 years, these are the companies that usually have really high number of ounces, definitely greater than 5 million ounces. They're usually low grade. They can be in some of the more difficult places in the world to access and to develop in. And therefore, they're usually these marginal deposits that don't attract a lot of attention until you get into these bull markets. And so my question to Rick is, now that it looks like we're in a bull market, is it time to buy optionality? And he had a really interesting question, and something that actually we've talked about before is, how much different the sector was 10 years ago, 20 years ago in terms of access to information, who was distributing information to the masses, and how, Rick even says in the interview how he was a big part of that proponent to pushing the optionality idea and the investment in it. But what he says now is these optionality or these marginal deposits aren't cheap anymore. That opportunity that was there, 10, 20 years ago, just isn't present. And I thought that was really interesting. And I think it's probably something that all investors should probably take heed of. And when they're looking at companies and maybe getting too blue sky, like when you see 20 million ounces or 40 million ounces, stories like International Tower Hill, that's one that stands out, I think, from like 15 or 20 years ago for me, that there's still a lot of hair, so to speak, on these companies. And so that valuation that you're seeing today probably doesn't have that margin of safety that you'd be looking for, even though it is a bull market. And you're probably better, more often than not, to stick with the best of the best, or what you think is the best of the best.
And even on some of those optionality, like my observation is studying cycles before I was a part of them. And then this will be my third precious metal cycle, 2016, 2020, 21, and now 2025 moving forward. Like the International Tower Hills, you get the darling status like for one cycle. And after that darling status wears off and it's been 10 years and nothing's happened, you're realistically not going to get the darling status and in a premium relative to peers. And it has to be a new story, something fresh, because just the psychology of how speculators look at things, they can say, okay, this is already run up. And it just doesn't have the gusto. It's like you look at the tech sector in the 2000s, right? When it's a new idea, it's a new concept, something, what could this be? And there's no precedent for it. Then you get these bubbles. You can even see it. And I remember in 2017 in Australia with Quinton Henning, and they said this could be, some newsletter writers were saying it could be 2 billion ounces, the next Witwater Rand, right? And so that stock just goes on a rung because you're selling a concept that is like it's so beyond what other people are even claiming. And for those that believe that, like the psychology of it, the run up, or there was another company in Namibia a few years ago, in the oil sphere, and they said we're unlocking this massive, oil field, and they ran to a multi-billion-dollar market cap based on a concept, on a theory. And so, like, when you see those sold to the market, it's a one and done. And a lot of people that made a lot of money off of that run up, and the company's escaping me. It's going to come back to me during later on in this show, I'm sure. But you get a one and done. And a lot of the people that made money on that run up, that were in charge of that company, the oil company, they moved on to their next thing already, Brian, because they understand, and that's the psychology of it. But what I liked from your interview with Rick Rule was his comment when he said fear is a rational response to laziness, in terms of if you don't do your due diligence, and things aren't going well in the stock and you're like, you get fearful. Well, you should be fearful because you didn't put in the work. What do you think of that one?
Oh, it's absolutely true. I think it's very wise thing to say and to bring up in that context. And I think that is the problem with probably about 80% of the fear out there is probably linked to laziness, as he suggests, and that people, just my interactions and questions as a newsletter writer have pointed to the fact that a lot of people are more interested in just the picks rather than the rationale behind picking the certain company, or the detailing the thesis of why you're buying a company and where you're going to sell it and how you're going to sell it, those sorts of things. And so that it makes a lot of sense that the two are connected. I do think, though, on the other side, there is probably that 10 or 20% that is maybe built into self-confidence, or maybe just built into your own psyche about how much risk you want to take. And I think those are introspective things that you have to realize about yourself and sort of apply them with how you're speculating, or maybe you shouldn't even be speculating. The junior resource sector, we often talk about risk in the junior resource sector. But if you think of it in the broader terms of junior resource sector investing versus IBM, 20, 30 years ago, or Microsoft, or like these huge kind of blue chip companies, everything in the resource sector is risky. And therefore, if you're looking at this sort of thing and you're being fearful, one of it could be laziness, but the other thing could be yourself just telling you, what, I don't like to risk my money. And I can tell you, having lost money myself, you truly don't know how much you hate losing money until you do. And they say that you experiences, or you feel losses much more than gains. And I would absolutely agree with that. Again, speaking from experience. So a lot of this stuff does require introspection. And I think that's like probably should be the hallmark of any investor before they dip their toe into the junior resource sector, that they're kind of taking a look at themselves, the experiences they've had with profiting and losing money, and see where you lie on that spectrum. And that should lead you in the right direction of where you should be placing your money, whether it should be in the junior resource sector at all.
So I just looked up the company. It was Recon Africa, just that I was referencing there with the story they sold in Namibia. Okay, Brian, so I was thinking about this. Do you fear losing more? You fear missing out more? Fear of missing out? Or do you fear losing money more? Like when you look at a speculative opportunity, what weighs more on you?
That's interesting. I start with protecting my downside. And so I would say that probably, I'm probably looking at not losing money being the first thing. The lost opportunity, there's just so many lost opportunities that you're going to see, you're going to pass on. And I don't think you can get upset. I think more often than not, saying no or passing on a new idea is probably the best thing to do. I've been, through my experience and through mentorship, I start with protecting my downside. You'll see there's so many stories that seemingly work in terms of the narrative, in terms of how the story is pitched. But then when you start getting down to the numbers and realizing that this company is probably trading at fair value, maybe they're overvalued, maybe the promoter is so good that this thing has got a premium, and it's still a really good idea. But more often than not, you'll probably end up losing money on that. And that's just my experience, and it's what I've been taught from mentors. So if you start with protecting your downside, seeing what the price to value ratio truly is, and making sure that you can do as detailed calculation or hypothesis on that as possible, and going forward. And if you protect your downside, as my mentor would tell me, is like, if you protect your downside, the upside will take care of itself. And that's absolutely true. When I changed that in my process and put that first, I really excelled in terms of my stock picking. And I think that should be, next to introspection, price to value ratio needs to be right at the top of your list.
So Warren Buffett doesn't speculate in what you and I put our money into. However, he does say, along the lines of what you just shared, don't lose money. And then the next rule is, remember, don't lose money. But then he also teaches, like using a baseball analogy, that just think of yourself in the batter's box with no called strikes. It's only a strike if you swing at it and it's a foul ball, or you swing and you miss. So I watch a lot of baseball with my sons, being on travel baseball teams. I just did another tournament for my son this last week. And so if you are, you like it deep in the zone and outside, and you like to take it opposition for your hitting style, if you're a right-handed batter, then you just wait till you get it deep in the zone, in the strike zone, and you hit it opposition to right field. Or if you like it high and inside, just wait for the high and inside. It doesn't even matter, right? If the deal you're being pitched is a strike, just make sure it's the strike that you like, where you feel like you have the competitive advantage or the insight to take advantage of that. So I like that analogy. Did you want to respond to that before I move on to this next thing I learned over the last MSEs?
No, that's extremely wise, Bill. Like that resonates with me more probably than ever. Taking the swings at the proper pitches, I guess, if we keep on with that analogy. But and it was, again, like Rick and I started talking about it with portfolio allocation, and it's sort of a conclusion I had come to over the last couple of years. And it's actually following the losses that I took in 2022 and 2023, which is a great learning experience. But it was kind of pointing in the direction of taking the swings at the bets on the proper companies that fit my style and fit me. But then when you really know a company, and again, this is whether it's a ruleism or a Buffettism, going a higher allocation on those bets or those companies that I'm that much more confident in. And as that confidence level rises, I'm definitely more apt these days to buy at higher prices if I think that confidence level is going up and that differential for profit or price to value ratio is still there. So that is exceptionally wise. And I think people need to take heed of that. That might be a more advanced topic for like more advanced, maybe not a newbie to go down that road yet. But those that have been speculating for a while, I think that's something you want to think a lot about.
Great. On the idea of confidence, I interviewed Michael Gentile when I was in Quebec City in person. And I asked him about two of his positions, one that was doing well in the market, very well, North Isle Copper and Gold on the north end of Vancouver Island in BC, that PEA stage project, doing very well from a share price perspective, and then contrast that with Arizona Metals, which wasn't. And I asked him to comment on the two side by side. And I like what he said about Sam Lee, the CEO, how over the last 4 years, he's laid out expectations, basically told the market, this is the forward-looking statement, this is what we are raising money, and this is what we want to do with the money. And because he kept on hitting those marks and meeting investor expectations by fulfilling what he told the market, then you put out this PA with great economics, and boom, like the share price responds to the PEA. So it has to do with the promoter laying out the expectations, the forward-looking statements, meeting it, and then there's this like compounding belief and trust from investors, like this guy's actually going to do it because what he says works. Now, when I think about some of the stories I've been in a number of stories that were not cash flow, supposed to be going into cash flow, ramping up cash flow in oil and gas, in recycling, urban mining, and in mining. And when I think about like the profiles of the executives in a number of these that did not succeed, that there are one executive I can think of, I would buy a used car for him, Brian, but I wouldn't invest in any resource company that he's in charge of again, because I think he's honest as the day is long, but I think that his weaknesses won't allow for him to successfully do, because he didn't successfully do for me and other investors. Another executive I would say is qualified and is generally good. However, when put under pressure, won't make the best decisions or might even compromise. And then a third profile is you just can't believe anything that he says. And I don't even know if he believes his own male cow manure, or he's doing it on purpose, or he's self-deceived himself. But basically, you can't trust the forward-looking statements, because so much of the information that we take in when we make a speculative bet, right, on a high-risk, high-reward proposition is based on what management says. Any thoughts in response to what I shared?
Yeah, well, first off, I have great respect for Sam Lee, former banker, transitioned into junior mining CEO, and he's a guy that right from the start I definitely was very interested in investing in. I never did, to my regret, but he's been high on my list for a while, and if you'd have to go back more than a year, but I have talked about that in the past. I think the banker turned CEO, I think in a lot of the cases that and there's a few names that pop into my head right now, I've been really impressed with in terms of how they transitioned into CEOs, especially those guys that, were bankers in the junior resource space, know the financing side of it, and have put together good teams and executed. Like that's probably been, they separate themselves just in that. Those kind of files that you put them in, I think that's really interesting, and it's probably been my experience too. I've never put them into those bags before, but yeah, I completely agree.
So I interviewed Ed Bear, first interview ever with Ed Bear, a mining executive and investor out of Toronto. And in that interview over the last month, and I can link to all this if you haven't listened to it, I would encourage you to go listen to that interview I did. But he talked about why Ross Beatty sold Lumina Gold, what he believes, cheaply to that Chinese corporation. And this is like a 17 million ounce low-grade gold deposit in Ecuador, the Congress gold deposit.
And it was Singaporean.
Singaporean. Okay, I apologize. Out of Asia. So, but he says the reason why he sold it, because he thinks he sold it for 1/3 of what it should have been sold for, is because Ross sees the tide turning in Ecuador. We know that Ross went into Ecuador when people were kind of down on it, and the Ecuadorian mining companies had to operate under more of an oil and gas regime, is what I understand. And so the government was less favorable. But Ross saw the geological opportunity and believed that the favorability from a political standpoint would shift. Go in there, so buy at a cycle low and get those assets, develop those assets. And Ed says that Ross is now exiting because the tide is turning and Ecuador is going to turn over for the negative. Now, I had some conversations with people in the know after that, and I asked them their take on that. And one said, no, Bill, I don't agree with that. I think it's more just that it was a low-grade asset, even if it was 17 million ounces. That was one person's take. And another person's take was, yes, I agree with Ed that things could be turning over in Ecuador. Any thoughts in response to that, Brian?
I'm a blend of both. Ecuador is super hard from a number of standpoints. I think over the last 10 years, they've made huge strides to sort of go in the right direction after the Kinross's Fruta del Norte disaster. and Lundin was able to buy that out pennies on the dollar. And I think that really marked the transition from, or a bottom in Ecuador, to this sort of ramp up where we've seen BHP, we've seen like a lot of the big senior mining companies sort of slide money into or invest money into Ecuador. I've invested in Ecuador over the last 10 years. It's really a mixed bag. And while I would say the current president, which the name escapes me right now, it's a young guy, and he's more conservative, more business savvy. I would say that the country could flip at any moment, and even if at the political level, if the political level stays right wing or more conservative, I still think that Ecuador is the perfect example of a country where the locality matters probably more than anything. And if you're in these certain regions that have more issues on the local level, it probably doesn't matter whatsoever with the president, who the president is, or what they're necessarily doing. So Ecuador could flip at any point, as far as I'm concerned. The other side to it is, I would sort of agree with the other, I assume, gentlemen that said that it's a low grade deposit. It is. It would definitely be on the more marginal side, sort of that optionality sort of company. If you look back a year and a half, 2 years, where, you know, they weren't getting the recognition from the market because rightfully it wasn't, even if it was economic, it wasn't economic enough to catch the market's attention in a bad market. And so to me, I would lean towards, yes, Ecuador is a hard place to operate. It could turn on a dime. But the deposit was also marginal. And I think a guy like Ross was probably looking to put that money into do something else, whatever else that might be. That's, you know, more at the higher end of the quality pyramid, and hence why they sold it.
Brian, I talked to a Canadian broker this past week, and he believes that the whole sector is moving towards life financings with no 4-month hold. Do you see that? Any intel from people you've talked to? Do you see that trend playing out?
Well, the other thing that we talked about with Lisa Davis was that the life financing, and I'm not sure if this was recent or if it's something that's going to be proposed, that the life financing limit had been moved from $5 million to $10 million, which certainly opens up the door for this to become more common. You're still only allowed to do it once a year at this point, but I could see it moving towards that. My personal opinion is, I don't see why you couldn't have all the financings be life, meaning that there's no 4-month hold. I think it would change how the market operates. That 4-month hold, I think, was originally instituted to sort of protect investors. But I think it can bite them too, because after 4 months, I think a lot of people, if you're not really cognizant of it, forget that those shares are coming online and can be sold after that 4-month hold. And so, you know, you're always at risk. So I'm one to reduce regulations and put more emphasis on investors being more responsible for their actions. So for me, I see no reason why you couldn't have life financings, or the idea of having no hold period on those on a financing moving forward. And I personally think that the market would probably be better for it. That people are have to be that much more cognizant of shares coming online. And I also think that might, like, if you were gonna, these guys that try to start companies with low cost of capital and promote these things to the masses and sell shares, like, if they're going to put hold periods, or if they're going to put escrows on shares, that's where it should be regulated more than it is. And it would stop a lot more of these pump and dumps, which I think are much bigger risks to investors rather than the regular financings. That's just my view.
What about, okay, so you obviously take more of the libertarian perspective, so like deregulation. Do you think that it should be, if there is no hold period, that there should not be warrants attached? Because that was a discussion I had as well. And obviously, like, a lot of the brokers like warrants, and that's a huge, it's easier to raise money where you say, hey man, you get a full warrant at 45 cents. Listen, just do this financing. I'll flush your stock out over the next month. You get all your money back, free upside, and I get my 7% commission. I mean, right? So the whole brokerage industry would like that. What's your take?
First, you know, I would rather pay them a fee And if they want to buy stock, if they believe in the company, then buy stock and benefit from that perspective rather than the warrant payout. I think that the warrants is it can be a hard thing to take away from the sector. I do think it needs to go. I think if we're talking about risks to investors or to retail investors, that's probably more risk than, again, the 4-month hold period on the original principle. Those large warrant overhangs that can, stymie a stock's climb or cap the uplift of a stock that has good results is huge. And I think if the sector wanted to get better and if the regulators actually wanted to do something that was prudent in terms of making the sector safer and better for investors, that would probably be where I would be placing the regulation is on things like that and ridding the sector of the warrants. The brokers can still get paid a fee, whether that's 6% or I think the most common.
They got to sell harder though, Brian. They got to sell harder. Though the brokers do, I mean.
Right.
So because I've seen it. I've been in companies to where the management is not good with House Street and Bay Street. And so they over dilute because the brokers take advantage of them and they allow the brokers to take advantage because of their weakness. But then the brokers want a prospectus, so there's no hold. And the brokers want tradable warrants because, man, this is such an easy sell. I'll raise for you tens of millions of dollars, right? So the brokers do want an easier sell. Now, the other argument, though, is for the people writing the check, okay, you're taking away my upside. Listen, this is a high-risk endeavor, right? This development project or this exploration project. So you want me to write a check into this. So when I do my risk-reward assessment, like the asymmetry is not there for me because I don't have the leverage on the upside if this works out with the warrant. Therefore, I'm not writing a check. So that would be like the counter argument to what you just shared.
Yeah, I get it. I get it. I guess I just lean more towards it being better for the sector overall if that wasn't the case. If the investments were made purely on the spec and you sort of have to, that's just the reality, is that you don't have that piece of paper in the background that you can, that option to execute. And it would change the dynamics of the sector. It really would. And I'm not sure, to me, like my initial thought is that it would be better. Maybe it requires deeper thought on that. And, Rick Rule has been a big proponent on warrants. And I think that's exactly the position that he would take, is that especially in the high risk exploration companies, that's sort of the only reason why I'm going to give you money, is that sort of optionality with the warrant. So I get that. I get that. I just think overall that the sector, in the stories that I've been a part of, the stuff that I've seen, that the sector would be better off without the warrants. And there's a subset of companies that I've seen, Orion Resources being one of them, that have never, at least to my knowledge or off the top of my head right now, haven't issued warrants in any of their financings, and they're still able to finance, high risk gold exploration, albeit with a great team of people. But I think that should be more the commonality, and maybe that would weed out some of these weaker management teams, or those teams that aren't able to garner the interest from, the bigger money or the smart money. Maybe that would be overall better for the sector.
Okay, so you mentioned the warrant overhang. Just one more point on this, because in the course of this conversation with the broker, I mentioned how with the tradable warrants that can take that supply, the demand that meets more, there's more supply on the market to buy concerning a certain company, the warrant and the stock itself. So when the demand comes in, that's going to lessen the move up. He viewed it differently. He said, no, my take is that because the warrants, even if they're tradable, won't be exercised towards the end of their lifetime, that overhang isn't so much on the stock. And I said, well, I can name this experience in this brokerage house who did this financing of a company I was in, and that's not what I experienced. But maybe I don't have a broad enough perspective. Any insights?
Well, I'll just relate back to my experience, and then I'll relate back to a particular mentor of mine who told me right from the start. He's like, never invest in a private placement based on the warrant price or how sexy the warrant might be. You have to invest based on what that price is of the financing, what the hard dollars are at, and the warrant is the gravy. My experience, out of the number of private placements that I've participated in over the last 9 years, I would say 60 to 70% of the warrants that I've got through those placements, I've never exercised. I would say 10% of those warrants were me being greedy, and I would say now dumb, in trying to wait and maximize that buffer or that profit horizon for those warrants, and waiting if it was a 2-year warrant and waiting until I was, a year and 10 months. And when that differential should be the biggest. And again, that has been a mistake. To me, and again, this has probably come down to strategy, and maybe I'm that much different than other people. But I'm much more apt if I've got 30, 40, 50% and I feel confident about where the company is headed, that I'll exercise a warrant in 3 months, in 6 months. It doesn't really matter to me. I'm not taking that perspective that this thing is going to look that much better in a year and a half. And in fact, I'll exercise the warrant. It doesn't mean I necessarily have to sell all the shares. I'd rather exercise it, hold it, and then sell into volume if it happens. Or if I want to hold, then I'll hold from that perspective. But this whole thing waiting till the end, I think that's a poor strategy.
And I agree with you. And when I've been deeply in the money on a big warrant position from a placement, when I didn't exercise when they were significantly in the money, I didn't exercise at all because they later went out of the money. But I'll say this about warrants. I agree with you in terms of don't make your investment decision based on whether you get a warrant or not, just on the share price, the unit offering price. But when I've had a really big win and there's been warrants attached to it, and even if it's been only 5% of the time that I did a private placement, it was so worth it that I want the warrants, So that's...
I hear you. It's always fantastic when it works out. It truly is. I can't say anything bad about that because I've enjoyed it too. You're absolutely right. Those big wins when they do come with warrants, is more than gravy. It's certainly that icing on the cake. So I get why they're there. I just think that in the reality of the sector, what I see today, I think the sector would be better without it. It would restrict who gets cash. Only the best management teams, only the most connected management teams would attract the capital. And I think that would be a net good, not only for mineral exploration, but just the overall outlook for especially generalist investors who look at the junior mining space, have maybe experienced it in the past and got burned. Again, the reputation of the sector, I think, would be that much better if you didn't have that sort of overhang. But I can't. I've benefited greatly from having those warrants, so I see that side of things too.
All right, one more before we move on. One more thing that I like that Rick said, and what you just said kind of brought my remembrance back, was you asked him about bootstrapping. We're going to bootstrap this small deposit in order to fund exploration or some other aspect, right? And he pointed out to you, the good management teams, they're not going to mess around with a small deposit because they have the ability to raise more money to go after bigger fish. So he said, just factor that in. This is kind of my articulation of it, that these guys may only be qualified enough or capable enough to raise a small amount of money for a small deposit. So just factor that into your assessment of what you might invest in.
Extremely wise. Extremely wise.
Yeah. Brian, we had a question come in a couple months ago, and sorry to the listener who asked this, and we said we were going to answer it, but we haven't the last couple chats Brian and I have, but it was regarding confidentiality agreements. When an issuer, a company, signs a confidentiality agreement, usually with a corporate that's doing due diligence on it, or perhaps a large investor, what does that large investor or corporate that signs the confidentiality agreement have access to that the average investor just consuming all publicly available data doesn't have? Now, you reached out to a CEO, and what did you discover?
So the CAs basically give the senior company or whoever signs that CA the access to the details. So whether it's, let's say in Canada, it's the meeting minutes that surround their meetings with First Nations. They'd be able to see how that develops over, a few months or a year. They'd be able to go back. They'd be able to look at that environmental data that's available, how those studies are being conducted. So really the difference between what we see as investors in the public domain and then what you see in the CA is those nitty gritty details. And that's the access to that information, and how that is put together is basically the advantage of having that CA. So in reality, I think that, it's definitely an advantage to sign that CA and see the details. But I think, most of the stuff that's pertinent, you're going to be able to find, especially like with First Nations. A lot of the First Nations, at least in BC that I've had experience with, are publishing their own monthly newsletter, which sort of encompasses sort of their dealings with, to an extent, with any mining companies that they're having talks with. So I think all the information is sort of out there, if you go digging for it to a degree. But it's the amount of detail that you get when you sign the CA is the hallmark of the deal, and that's why they sign it and why they're comfortable or not comfortable, because they know exactly what those dealings are, and they're not just listening to or reading a slide deck or listening to the promoter talk about it.
You've got a lot of questions from your subscriber base over the last month. What are some issues we should talk through?
Well, why don't we start with books? I think I've definitely seen an upswing in subscriptions. And a lot of the questions I would say have been on that newer investor scale. And one of the biggest or most common questions I've had over the last month or so is the best books to read in the sector. I guess best for like the investing side of things, and then the sort of mining focused. So what do you think?
Oh, okay. I got my list. All right. The first one comes on every 3 months if I can pin him down. Dr. Rob Stevens, Mineral Exploration and Mining Essentials. This is a great book that you need. You need to start with this one, okay? Great pictures and great visuals if you're new to the sector. Then also get this one, How Mining Works by Scott Dunbar. This is a great one with visuals too. So you got to learn the mining industry. Start with those. Then Brian, a few months ago, I think it was 3 months ago, interviewed Jacques Bonnet, The Art of Investing in Junior Mining. Why, where, when, how much. You got to get this one. And he teaches you how to think like an investor. He's a geologist, but he's also an investor himself. But you want to get this one. Then, if you're going to speculate, because this stuff is so risky, you have to read a couple books. And this will allow you to think through the psychology of the people pitching the forward-looking statement or the proposition to you, and get you to think about your own psychology as it relates to taking these bets and your relationship to money. But one is a great one called Thinking in Bets, Making Smarter Decisions When You Don't Have All the Facts by Annie Duke. Now, this is not, she's a poker player. So poker is a game in which you have some information, but not all information. And you're taking risks. So what we do as speculators, we have some information, not all information. How certain can we be regarding the information that we have? And with that, we have to make a decision. Are we going to place a bet on these companies like poker? And you determine how much based on the information you have, what the risks are. You determine how much you're going to put on a specific company. So she takes you through this rationale. This is really good. And if you know Howard Oakes from Oak Tree Capital, he wrote a little memo here, okay? And I can link to this. I'll upload it to Mining Stock Education. I'll put a link in the show notes for you to download this one, but you got to read this. Then read this. If you don't have time for a full book, read this, because Howard Mark actually interviews Annie Duke. He liked her book so much, and he wrote a memo called You Bet. And this is excellent, again, because what we're doing is speculation. And I want to read just a little something he wrote in one of the first paragraphs of this. Because of these two factors, well-thought-out decisions may fail, poor decisions may succeed. While it might seem counterintuitive, the best decision maker isn't necessarily the person with the most successes, but rather the one with the best process and judgment. The two can be far from the same, and especially over a small number of trials, it can be impossible to know who's who. And that's because those two elements are the unknown element and the randomness or the luck element that they talk about. But you'll want to read this. And that would be like my quick, hey, you got a month of study or you got 2 months of study and you're new to this. My current recommendations would be these things. I know I threw a lot at you, Brian, but I was prepared for that question because you told me you were going to ask it. What are your thoughts?
Oh, those are great picks. They would be definitely high on my list. I'll add a few. I'll say the Inserto by Nassim Taleb, which is the Inserto is all of his books, but I think Fooled by Randomness and The Black Swan are probably the two most important from his Inserto collection. I would say that there's a book called The Battle for Investment Survival, and that's by a New York stockbroker called GM Loeb. It's a little bit of a different one, but there's a few chapters in that book that particularly I've read over numerous times because I think it's pretty pertinent. And then you touched on Howard Marks. I have tremendous respect. And I would read again anything that Howard Marks has written and put it at the top of your list. And those are all sort of on the investor side. You covered the mining side very well with the books that you mentioned. But those that are looking to increase their investor side of things, I think, the names I just gave are really good to beef up your knowledge.
And I forgot one more because I had it on the other side of my desk when I was grabbing books. All right. This again deals with psychology, and this one by Maria Konnikova, New York Times bestseller, The Confidence Game, Why We Fall for It Every Time. And she goes through and does studies, historical studies, and even talking to real modern day con men to lay out the psychology that is within the con man and how the con man tries to exploit the psychology within you. So it was a great book because it gets you to think through your weaknesses and what you could succumb to. And in a moment of self-disclosure, and don't beat me up in the comments, I'll just say this, Brian, I was conned yesterday. So I've been biking with my kids, and we've been biking from our house to these trails near where we live. And it was like, it's just a lot of fun. My little girl, I bought her a new bike, and I was like, oh, great, father-kid activities and a lot of fun. So then just how, the internet knows everything you search for or do because it studies us. Then I was getting these ads for these, different mountain bike with fat tires. And then there was an e-bike. And with a mountain bike with fat tires, I'm like, oh, that would be great to take on the trails. And it says going out of business. And it shows a picture of a store with all these 70% off price tags. So I click on it and I go through the website. I was like, oh, wow. Instead of $2,000 for this bike, it's only going to be $399. And then I go through checkout. I'm like, nah. So I leave it. I come back to it the next morning because the tab's still up on my computer, and I look through it again, and I'm like, okay, it's $400. I said, I'll do it. So I go through, I buy the bike, and then there were a couple of things where I kind of questioned. I was like, is this legitimate? But I let it bypass, Brian, and I didn't do further due diligence because I said, oh, if it's just $400. And I click buy, and then I didn't get like the confirmation email, and I didn't get things. So within 15 minutes, I was like, did I just get scammed? And they only gave me PayPal as a checkout. And when I was checking out with PayPal, it didn't let me use the credit card assigned to my PayPal. It only allowed me to do the debit from my bank account because my credit card declined the purchase.
Oh, wow.
Within the PayPal system. So long story short, I'm like, I went to their Facebook page, started to scroll down. And then when you scrolled back 4 years on their Facebook page, this supposed wholesaler of these bikes, then it got to be a picture of a woman posing, in some country that's not my own. And I was like, oh man, I just was scammed. So as soon as the actual retailer was open, I called them. I said, hey, I think I might have purchased from what I thought was your wholesaler, but is this legitimate? He's like, no, that's a scam.
No.
And I was like, you guys got to get this off the internet. And so then I had to put a hold at my bank. And my point is, Brian, there were a couple red flags that I kind of went past because I said this was such a good deal. And I blew past those. and I ended up buying, but then it cost me like at least 90 minutes of my day yesterday trying to work to get that payment stopped. So, and undo my mistake. But there's a lot of people out there that'll look to take advantage of you. And that's why this book is good, The Confidence Game, because it gets you to think through, like, what are your weaknesses and vulnerabilities of how people might exploit you? That was kind of a long-winded answer.
That's good. I think in terms of whether it's con men or con websites, I think with the advent of AI and where the future is headed, I think people have to be that much more awake about, what they're actually doing and realize that it's a risk. And more than ever. And the reality we both discovered in the resource sector is that not everybody tells the truth. And not everybody will do what's in the best interest of investors. That is the reality. And I could talk for hours from firsthand experience on that. Yep.
What's next?
Well, I think it's prudent just because of what's going on in the world. The conflicts are heating up in the Middle East. And I don't even know if it necessarily has been quelled. We sit here today and at least the narrative across social media and a lot of the news websites is that we're headed towards peace. You just never know. But I was wondering for you, as an investor, does this sort of noise or does the magnitude of something like this impact the way that you operate in the sector as an investor?
I don't think it does in terms of if I already own the company, but it calls me to maybe be more hyper-focused on my watch list. Okay. So yesterday there's a couple companies that I'm researching, and those companies are up 100% off of the Liberation Day tariffs. Remember when everything dropped that day? Like literally companies spiked down 30, 45%. And then now some of them I'm looking at are 100% off of that bottom. So it does in that regard, Brian. Like if there's a company that I like that's on my watch list and there's a precipitous drop, another miner that I like is like $13.50 a share, I believe, last time I looked. That thing dropped down under $9 a share, just briefly after trading like up to $14 a share. And it was on my watch list, and I didn't buy it. And then it's back up to where it was beforehand. So in that regard, how the geopolitical psychology and narratives that are thrown out there and happenings, how they affect companies I like, it caused me to be more attentive to my watch list in particular for a steep drop off that probably is only temporary.
Right. Well, I'm very similar. I'd be looking at capitalizing on any drop that's caused by conflict. Like one of the best things I ever did as an investor during the COVID crash, that March, there was 3 specific days where the market sort of took definitive steps down, that I was a buyer on all 3 of those days. And in 2020 ended up being the best financial year I've had to date. I do think that there's going to be better years ahead, but capitalizing on those crashes was a massive thing. And then sort of having the mentality that you need to buy those is I think, very important. The other side to me is I think the only other caveat that I'll say, and I'll talk about my portfolio in general, is that I'm probably more prone to keep a certain percentage in cash, especially with something in the Middle East that I think if you asked me last week, I was much more nervous about where things, or maybe negative about where things could be headed. It's just seemed that much more serious, especially with the U.S. sort of taking the stance that they might be coming in, and of course they sort of did. So I'd be more prone to hold maybe 5% cash in my portfolio to be able to capitalize more on that opportunity that we're talking about. Whereas prior, if you go back a month, maybe 2 months ago, I'd be very comfortable going down to fully deployed or maybe 1% cash. And in terms of bringing on a new pick or a new idea. But now I would keep that probably 5% cash, 10% cash, just in case that opportunity arises. And so that cash will be raised from taking profits, because the portfolio has done really well. But it would be out of sort of defense and offense in mind. So.
Anything else? I've led the conversation thus far. What else do you have of the last month that's of interest?
Well, the other question that I was getting from investors too is like in the newsletter there is an extensive watch list that I publish, and the question that was asked by 2 or 3 new subscribers was how I come up with new ideas to put on that watch list. And so what do you do in terms of new investment ideas? How do you get them? Do they go on a watch list first, or do you buy right off the hop?
It's through a person at this point. It has to be through a person, whether it's from you or someone else in my network or someone I interview from my show, to where they bring up a company they like. Then that'll go on my watch list. I'll do due diligence, come up with some questions, maybe go back to them and say, hey, well, what about this? Or do you like this? Or why did you not consider this a risk? To where I can actually ask somebody that has skin in the game. So at this point, it's usually through someone in my network or through a direct meeting that I have with management. Now, the company that I referenced without naming, that was like $13 a share now, but it went down to like $8 or $9 a share during the Liberation Day tariff threat sell-off. That company, I get put on a lot of email lists, actually, where companies will go public. They'll hire an IR firm, and then whatever, they scrape the internet of people that care about mining stocks, and then I get signed up for a whole bunch of lists I actually never put myself on. So that idea actually came from a list I was put on. Then I started researching it. Then I contacted management, and I've had, I think, 3 meetings with them, asking them questions over time. And I first took a meeting like last October. So now it's it was 8-9 months later. I still haven't bought the stock. I should have bought it when it dipped. But that would be an example of how I'm kind of doing it right now. And it just, some of them I was referred to, some ideas I was referred to. Then when I was in Vancouver in January, I made a point to go to their offices and meet with them in person too. So, as much as I shared that story about getting scammed out of $400, at the same time, I think that I don't just throw my money around too quickly. So there's a balance, but, maybe I'll throw what would be to me a smaller portion. I might throw around too quickly, but especially for a bigger check, I'm not going to do that anymore.
Right. For me, like I do scan some headlines, over the last 9 years. Like I've got a few different watch lists that are set up by metal, some by jurisdiction, some by people. And I'll add companies to that, and I have for the last 9 years. And you can imagine how big that sort of watch list is and how it's kind of broken down. And so while the majority, I would say, is exactly like you, that network is probably the number one, either people I've invested with in the past and they've got a new deal and I'm following them into that, or I've been introduced to a company or maybe even a person, and there's an idea that sort of comes out of that. So maybe not direct, but indirect, but it's still out of those conversations that we have in conferences, or even like you mentioned, doing interviews have been a great avenue for talking about different ideas, and those can spur into direct ideas and be indirect. But the other way is scanning headlines, seeing news flow that I think is good. Then I'll add that company to a watch list, and then I'm watching that company over time. And that doesn't mean it gets into the newsletter watch list or like my immediate investment idea watch list, but those other watch lists are just how I scan news flow and see how things are developing. I've got a pretty good memory too about how companies, what their stories are and how they're kind of moving forward. And so I'll loosely follow that. And if there's something that starts to get very interesting, and if I look at the market cap and it sparks my brain, then I'll follow up with that in terms of asking for a meeting and sort of going from there. And that's something that anybody listening to this can sort of apply to themselves. The other thing is, this is why, and we've talked about it before, it's so important to go to mining conferences. Start a network for yourself, whether that's company people that you meet, but probably most importantly, other investors at the same mindset, the same sort of companies and risk levels that you're interested in. And these are people that you can not only gain ideas from, but also share ideas from, and you can nitpick why you don't like that company, and you share those negatives, because hearing the negative is just as important as sort of having that view of what the positive is. And I can't say enough about how important it is to grow your network, and you do not have to be that well connected to start your own network, and so you can apply those things right now.
I encouraged a listener just this morning, actually, that emailed me asking me to interview a company that they own that they believe is being taken under in the sector. And I just encouraged them, because I don't know the situation that well. I haven't followed it. But this is your company. You're an owner of the company. Like, until you get a hold of IR, until you get a hold of the CEO, like, don't stop. I don't care if you own, 3,000 shares of a 20-cent stock. Like, if you're an owner of the company, act like it and get them to give you an answer because you're not satisfied with the situation. And I think more of us need to act like that.
Absolutely. Absolutely. I would say the better you get at gauging management, and depending on where that ranks in your priority list in terms of how you invest, but the better you get at choosing, the less I think you have to worry about being sort of activist. I think that, the activist standpoint is usually, what I would say is this, is I probably wouldn't be looking to take an investment in a company I knew I had to be activist in. Usually it's kind of out of a mistake or a misjudgment on my part. And then it's sort of retroactively, how do I want to deal with this as an investor, sort of as you're saying. And so I usually place the blame on myself and make a note to myself that I want to avoid this or that, that I missed, going into that company. Because like for me, in the situations where it's been sort of where I probably could have or should have been more activist, I just look at everything else that's going on as an investor and in my life. And it's like, do I want to take on that battle? And so for me, the preference is to get better at choosing correctly and sticking with the better people. And again, you want to go back to the conversation with Rick. I asked him if a scorpion is always a scorpion. And so his answer, I suggest everybody go back and listen to that. Because he essentially says exactly what I'm saying, is that, get better at picking the right people and understanding situations. And then you won't have to you won't be in those positions to sort of have to act that certain way. So again, I think it all comes back to that individual investor taking that responsibility for how you're deploying your money. And if you're getting into situations that require activists, then embrace it and do exactly what you're saying. Because I think for most people, there's a lot better things they want to do with their time than try to, chase management around, and sort of get the word out on these guys are bad or whatever. It's much better use of your time to stick to the good stuff. And I think the better you get at it, I think you'd agree.
Well, we appreciate your listenership. Thanks for hearing us chat through the junior mining sector. It seems to be a precious metals bull market, and uranium has been perking up over the last couple of weeks too as well. So we hope you make a lot of money. If you listen in audio only form, I don't normally ask for the whole like and subscribe thing the way a lot of YouTubers do. But if you listen in audio only form, if you wouldn't mind rating and reviewing us, we would appreciate that. Brian, always good to chat with you, my friend, and we'll do it again on the show in about 30 days.
Sounds good, Bill.